what's up, everybody? John here with the Nest Egg team, and I am joined by John Trama from CMG Loans, our local loan and mortgage expert. Pretty much knows every single thing about loans. No pressure, John, at all. We'll call this a Keeping Local episode, and we are here today to talk about the 50-year mortgage that's been proposed. And I figured who better to talk about this than the person who I think knows everything about mortgages, John Trama. What's up, buddy?
Hey man, thanks for having me as always. Yes, I read the news about Trump wanting to issue a 50-year mortgage. All I can say is no. I'm sorry. I think 30-year mortgages by itself are a death sentence. I mean, to pay a mortgage for 30 years, 3 decades of your life, there's no worse noose around your neck than a mortgage, personally. So extending it over 5 decades and to really drive it home, a half a century, man, a half a century. Who would
Painful
want to
when you hear
sign
that.
up for that? It's crazy, 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 crazy. There's got to be something other than extending out term, in my opinion. To be honest with you, I mean, if when you really look at the numbers, and we'll go through an exercise here, but it just really doesn't make sense in the grand scheme of things. I think most people, if you're comparing a 30 to a 50, there's not going to be much of a monthly savings where it really drive people to buy homes. Or I don't really think it solves the affordability issue, that most Long Islanders are facing.
hmm Yeah, so again, I trust you. Your opinion on the number side is more important to me than what I think. Like we were talking a little bit before we started. So I'm always okay with if what you're talking about really is the financial decision long term and a mortgage. Yeah, the 30 years it sucks in general, and 50 years it's just even longer debt, right? And it's holding on to debt. If you're getting that at a really good interest rate, it's one thing, but you're really just you're sacrificing a little bit of the monthly payment to have that lower and putting so much more on the back end. So yeah, investment wise, it doesn't seem great unless you refinance or sell, and we'll get into the numbers of why those things can be tricky.
Mhm.
Um, in my mind, it's like, yeah, is it better than renting? Like, yes, like because there are outs, you're going to build a little bit of equity, but again, not great. And to me, the problem is affordability is definitely a problem. Affordability is a problem with everything. But one of the biggest problems right now, why houses are so unaffordable, is because prices have grown so much along with interest rates.
Right.
So this doesn't, and the only way I see that being solved, because we can't control interest rates, and we need more inventory, except we have nowhere to build. And no, 40, I think it's 40% of homes owned right now are free and clear. So you're already talking 40% of homeowners. This isn't going to make them move. I did a survey on Instagram, a great source, directly to the people. So 30 people responded to this on Instagram, and 81%. I asked the question: would you give up your 3% mortgage interest rate in order to take on a 50-year loan? Because what we're really asking here is like, yeah, if you own a home already, are the people who need to sell are people who own their homes free and clear, or people that currently have a rate that's probably really good. We need movement in those areas in order for inventory to increase. The only way it's going to happen. 80% of people who have a 3% rate that responded to this poll said no way they would give that up for a 50-year mortgage. So to me, this doesn't help the inventory problem. This doesn't create more inventory. This doesn't get people who maybe bought like me, like bought in 2018, 2019. It doesn't get them to say, okay, now I'm going to move. Now I'm going to sell my house.
Right.
So I don't see it. And to your point, where if this does bring more people into the market, right? If it brings more buyers, and I know a lot of people said this, that just creates more competition for buyers, and that's going to just increase sale prices. And it's just going to, like, that amount of money that you might save on the new 50-year mortgage is going to be erased by the amount that you might wind up paying for the house.
Right.
But I'll let you, why don't you run us through the numbers and
Yeah.
we can get an idea.
Yeah, yeah, sure, definitely. So let's look at it like a $500,000 loan. Like, so if a borrower was going to borrow a $500,000, and let's use 6% as a base rate, that's kind of where we are today. And that would cost a consumer $580,000 in interest over a traditional 30-year fixed mortgage. So you borrow a $500,000, it's going to cost you $1 million to pay back. And I think where the numbers really tell the story is, when you start looking at, certain thresholds, 5 years. In 5 years from now, in that traditional mortgage, and this is why I'm a little sour on 30-year fixed mortgages in general. In 5 years, you will only pay down $35,000 in principal and have paid $145,000 in interest in just that 5 year period of time. Maybe pushing back the window a little bit. Let's go to a 10-year window. That's $81,000 in principal versus about $280,000 in interest over that period of time. I mean, we are completely lopsided. Most people don't really look at the amortization calculator or schedules and see how much money is being allocated towards the principal and interest. These 30-year loans are heavily front-loaded with interest. You're predominantly paying, as you can see, mostly interest in the first half of that loan. And banks structure these loans this way intentionally because they're banking on the fact that you're going to either refinance or you're going to sell and exchange it for a new 30-year, and it keeps you on that merry-go-round or that rope for much longer. So a 50-year is only just making it worse. These are, in my opinion, it's smoke and mirrors. I don't think it's really going to help. And now let's look at that same example now, same $500,000 loan. So instead of it costing you $580,000 in interest, it's going to cost you now $1 million in interest. So that same $500,000 loan initially, instead of it costing you $1 million, it'll cost you $1.5 million. And that's a considerable amount of money. And to really hammer the point, when you start looking at those shorter time periods, those time blocks, as I mentioned before, so instead of 5 years on a 30-year mortgage where you pay $35,000, now you're only paying $9,000 in principal. In that 5 years, you're paying $150,000 in interest. So it's really just not in my opinion, a good way to approach your financing. And in 10 years, you've paid off $21,000 in principal and almost $300,000 in interest. No, thank you. And this is at an equivalent interest rate. I'm comparing these from a 6% to 6%. And naturally, what happens is when you have a longer term, your rates get worse. 15-year rates are going to be better than 20-year rates. 20 years are going to be better than 30, and so on and so forth, right? So I'm comparing this from a standpoint where the rates are the same, and maybe that's what they do. They say, okay, hey, we're not going to penalize you for taking on a 50-year, but even if you keep the rate the same, you're still seeing how much more interest you're going to pay over the life of the loan. The payment differential, again, assuming rates are the same, was only $365 a month. Does that really move the needle? Does that really change affordability? I don't really think so. And $360 a month is really only increasing your purchase power by $60,000. So again, not moving much, the needle there either. So again, I just don't think that the 50-year mortgage concept. I mean, we've had 40-year concepts in the past. To me, they're not really worth it. And again, not really a big fan of the 30-year fixed either.
Yeah, well, we'll get into solutions later, because I know you have some.
Yeah.
Let's look at so going back to now the real estate side, let's look at someone who says, well, you know what, all those things work for me, and I'll just refi or sell. But
Yeah.
this is the other big question, because like you were saying, so typically, I mean, most loans last what, like 7 years, right? Is that the average, right?
5 to 7 years is the
5 to
average.
7, maybe 10 now with the 3%. They're going longer, but that's in general. So let's just use that 5 year mark of someone who says, you know what, I'm going to buy right now. In 5 years, I'm going to sell anyway. The thing is with the 30-year mortgage, you're getting a little bit more in principal, right? You're getting that down payment built in already for a future sale because you're paying more principal in general. For your example, 5 years, you've paid $35K in principal. Okay, so if you bought a $500,000 house, you've paid off $35,000, so that's added to whatever your down payment. So you have that moving forward plus appreciation. So let's just say that we go at a typical 3% appreciation rate. We've gone way crazier over the last few years, but let's say everything settles down, prices start rising like they used to, and it's 3%. So over 15 years, over 5 years, the first year, 3%, your house is going to be worth $515,000. Okay, then, so I'm not going to do all the decimals, but basically add 15 grand over 3 years. That's 45K plus the 35K that you've oh no, sorry. 5 years, 75K. 75 plus a little more. So figure 80 with the little extra that's in there, right?
Yep.
So you've appreciated 80K, you've got 35K that you've paid off in principal. So you've added $100,000 worth of equity in 5 years. Now take those same numbers. I mean, you're talking about 20 $25,000 less than that. You're looking at 75K in equity over 5 years if you're going with a 50K with a 50-year mortgage, which that only covers your closing costs on both ends if you're buying and selling. I mean, you figure, 4% on a buy side and the sell side, whatever realtors charge, can't say that. But do the math. So you basically, it's a wash. Whereas at least with the 30-year, you walk away with more money because yeah, that extra $300, like is it making it more affordable? It is. If you're paying more, you're putting more towards your principal. You're getting more of an investment out of it. I mean, that's a huge difference. That's $26,000 difference in 5 years if you go to 30-year over a 50-year mortgage. So to me, you're putting more money in the bank with the 30-year that you're actually able to use. And refinancing, this is more your side, but it's similar. So it's not a great investment, I think, if you're thinking about selling down the line and you're just looking to get into something and then sell. Will you come out ahead? More than likely, but I would rather, $300 a month. I'd rather do that, buy down more principal and walk away with more because that money is growing better in the 30-year mortgage with your principal than it is with the 50-year.
Yeah, no, definitely. I mean, it just comes down to some personal habits, maybe making some modifications to things that you would typically do. One of the things, I mean, it is a solution, I guess, but just adjusting your dependents and how you file your taxes. So instead of getting money at the end of the year in terms of a tax refund, maybe you're getting it through the year by manipulating your dependents, right? So that $300 can easily be repurposed in your paychecks every month to help offset that $300 payment. So you're seeing more money on a monthly basis instead of getting it at the end of the year. I'd rather you do that and keep a 30-year amortization. I think it just puts you in a better position ultimately.
Mm-hmm. And I mean, the other thing, which you could do this with both, but um, I see, it's nice to be in a position where you can put more money towards your mortgage with your payments already set with your amortization rate. Because like you're saying, you make a couple extra payments a year and that significantly drives down the cost. Whereas if you're able to do that, even on a monthly basis, put in a little bit more towards your principal, it's going directly to your principal and not to the interest. And with the appreciation, that's really making an investment in yourself in your own home where that money is growing at, I mean, we've really seen like 10% appreciation over the last 4 years, which is crazy. But even if you put that at 5%, that's basically like having a CD, right? Like one of those high interest bank accounts, but
Yeah.
you're putting it into your own house where you're putting $100. If you put $100 away every month, you're getting 5% on that towards your appreciation, if that makes sense. So
Yeah.
I
Yeah.
just think like you get that with the 50-year, but when you combine those two things and how much interest you're paying, it totally wipes that out with the 50-year. Like it's not the same investment as with the 30-year.
Agreed. Agreed. Yeah, and we can obviously set up biweekly payments to your point, to try to, offset some of that. But but even there too. I mean, it's really again, it's I hate to say it, but the mortgages are rigged to just to keep us on this leash for such a long period of time, and we need to do it because for affordability reasons, right? At the end of the day, that's why we're signing up for it. I mean, it would make a lot more sense for somebody to go in for a 20-year fix. A 20-year fix, in my opinion, you're going to get better rates typically than 30 years. They're not as aggressive in terms of your monthly payment at a 20-year amortization opposed to a 15. And as a result of that, but a 20-year is going to shave off a tremendous amount of interest over the life of the loan. And if you did biweekly payments on a 20-year, it takes you down to about a 17-year. Ultimately, I think that would be ideal. But again, when you start looking at affordability, and most people don't do it because
Yeah.
they don't want to be stuck, with these higher monthly payments. But I definitely agree with you. If you have the opportunity to prepay your mortgage, definitely do that. If you haven't set up biweekly payments, you need to inquire. about it. You just call up your loan servicer, you find out whether or not they offer it, which they typically do. And all you're doing is you're breaking up your monthly payment into two equal payments. And by doing so, you make one extra payment per year. And to your point, yeah, it goes towards your principal. But the interest piece of it still is working in the fashion that it is set up. Remember, it's an amateurized schedule of monthly payments, and those interest payments are getting paid the way that the table is structured. So any payments that you're making above and beyond is shortening your term. It's coming off the back end of your loan. It doesn't change the actual interest that you're paying in the beginning of the loan.
Mhm.
But a 30-year biweekly schedule, it shaves about 5 years a term off of your loan. So, I mean, if you're making, let's say it's, $3,000 a month over, 60 months. I mean, that'll save you $180,000 in overall payments over your course of your mortgage. I mean, that is considerable. It's surprising, but a lot of people don't do it. And I think the fear is that they don't have the control over it. But on the biweekly pay schedule, it's kind of tied to the way you get paid. And there's really 2 months a year where there's three pay periods, and
Mhm.
that's where that extra half payment is coming out. So you really don't feel it. And it's a great way to, again, to put yourselves in a better position. And if you can contribute more than the biweekly payments, then that'll just continue to accelerate it. But yeah, again, the 50 years just not doing it for me, and I think that'll kind of fizzle out. Or we really haven't heard the intricacies of what they're doing here. It's all kind of just surface level stuff at this point. So we'll see how it kind of shapes as we move forward. But it's definitely not going to be a saving grace for our market specifically.
Yeah. And do you think that underwriting for these 50-year loans are going to be like easier, similar, or harder because th're 50 years? Like what do you think?
I think they'll be similar.
Okay.
Yeah, I mean they'll kind of adhere to what the traditional lending agencies in terms of the 30-year fixed programs are modeled after. And yeah, I don't see that being much of a difference. But again, I think what'll happen is those rates will be a little bit higher because these investors are holding on to this debt for longer, and there's inherent risk there, right? The longer, and that's why rates are usually worse for longer terms,
Mhm.
because the investor is at the mercy of you making on timely payments. So the longer you have to make those payments, there's a chance that you can default on that. So therefore, they raise the rates.
Right. And now, just from the refinance side too, just going back to the numbers you were talking about, 9K in principal over 5 years with the 50-year mortgage.
Mhm.
And when you add those numbers up, and if appreciation is, the thing about a refinance is that the house gets appraised, right? An appraiser comes in and appraises the house, but some people don't always use a real estate agent to give comps either, but you're really going off of the appraised value, and it's not always 100% reflective of market value currently, right? Or what the house may actually sell for. It's fair market value, but the house could sell for way more than what the appraised value is.
Yeah.
So if you have a number in your head, like, yeah, the house could sell for this, okay, but that might not be what it appraises for. So if that number is less than the sale value, now when you refinance, I mean, you may actually have to, I mean, I know they could roll the payments in and everything, but you may not be getting a great deal on your next refinance and your mortgage as far as your monthly payment. Like you may be stuck in the same place or worse, depending.
Yeah, yeah, it'll depend on what's happening in the market, obviously. I mean, usually what happens when you do a refinance is you roll in your closing costs into the refinance. But to your point, if you're in a 50-year mortgage and you haven't paid much principal down, and let's say appreciation has been modest, you may not have the room to do that where you can roll in those costs. So then that causes you to have to pay for that refinance out of pocket.
Mhm.
So yeah, so it's not as, again, it's just not as it's not as glorious or glamorous as you would think. Oh wow, 50 years, this is going to make this more affordable. But there's definitely some downside, and I just think they outweigh any of the benefits here.
So Yeah, I 100% agree. And I'm going to give some solutions that I think, which won't happen, but I think they would work. And then you could give us some real solutions for what to do in these scenarios. But I think, first of all, again, going back to 40% of people own homes free and clear, right? And I'm sure those numbers probably play out on Long Island similarly. So just talking locally, um, I think if you want to get people to get up and move, you like give a 1 year or 2 year period and completely waive the capital gains tax for those people. Just waive it, get rid of it, so that if you're going to sell, you won't pay a single dollar in capital gains. Get rid of the transfer tax. That might inspire some people to say, okay, like I don't have to pay these taxes when I'll move because I'm not going to have to lose 50, 60, $70,000. Get rid of the mansion tax for a year or two. Get rid of all these extra taxes that, I mean, as far as I know, and I could be wrong, this tax money is not necessarily built into the budget. Like they don't know if this tax money is going to be coming in, right? This is like extra revenue. So if it's not planned for and it's not part of it, waive it. That at least get people, I think, I like me, if I'm looking at my finances, if I was in that position, I'd say, okay, it at least make me consider. No, maybe it's not a solution, maybe it is, but I say put a 1 year, 2 year moratorium on capital gains taxes, any taxes that are involved, like the transfer tax and mansion tax, all that stuff. Get rid of it for a little while. And then you might get the folks who are in that 40% that own free and clear to say, okay, I'm going to make so much more money now selling because the market, I'm going to crush it in the market, right? We're still doing well there. I'm not going to have to pay these taxes. So I'm going to net so much more and be able to use that money in something else. I mean, it should be an economic driver at that point. People like buying more condos, moving into communities, spending more money there, or there's benefits that come from it. So that to me is one way that they could inspire people to get out and start moving. Is it realistic? No. Do I think the government will ever give up on capital gains or any type of money that they can make off of people and taxes? Absolutely not. But
You never know.
if someone was smart, like I just might run for office on that right now. Like whatever it is, like here's my platform. I'm starting it. Like 2 years, no capital gains, no this, no that, no taxes on buying or selling a home. Let's go. And let's see what happens.
Oh my God. Let's not get into political conversation,
No,
please.
we're not going to get political, but I would just love to see that happen. Is
Yeah.
it's whoever's
Yeah,
in
I mean,
charge, federally, state, waive the taxes, let people just move without having to pay these taxes, and let's see what happens.
yeah. It's not, well, something, yeah, something needs to get, something needs to give, and this isn't it.
Yeah.
We've talked about porting loans and things like that. Where you can take your mortgage with you to the next property. I mean, that could help. For some people who have those low rates, but that doesn't seem like a realistic option at this point. But there needs to be something, and definitely over my head for sure, and my pay grade. So hopefully somebody out there can figure out a way
Yep.
to lift the logjam that we have. To your point, yeah, I mean, what's the motivation for somebody who has a free and clear property? What's the motivation for somebody with a low interest rate to now upsize and take a rate that's twice the amount that they're currently paying? It just doesn't play well in this market, and that's what we're seeing, and that's why we're still seeing bidding wars today. I'm having numerous clients still having the same problem, getting their offers accepted, and they're going 50, 75,000 over ask. So the competition is still really fierce here. We're isolated here on Long Island. I really believe it. What you read in the papers is usually national news, and those numbers are different from our local reality.
Mm-hmm. So different. I mean, just like you said, all the listings that we've had lately, I mean, gone in a weekend. We are getting the house listed. We're doing all our marketing stuff. We're doing the nest egg method, quote unquote, promo to me, and Elijah. But there is a method behind it, and there is data to back it up. But there are still so many people out there. There are people out there. They're hungry. They want to own homes, and I think that's great. That shows that even with prices and taxes and interest rates and everything high, people still want to own, they still want to buy.
Mhm.
And, they want to have the opportunity to do that. That's the most
Well,
important thing. And it's just how do you provide more opportunity for that? Still great to be a seller. I think as a buyer, it really comes down to it's great when I work with all my first time home buyers now. Like the first thing we do now, I've changed it up a little bit. we do a needs versus wants assessment, and we break that all down, and we go through like what are the deal breakers, what must you have, like that's the most important thing. And then we talk about how we can be flexible in certain areas, because if you're willing to have some flexibility in this market, you can find deals right now. Like, as much as we're saying that the houses are going over asking and there's bidding wars, how many price reductions are we seeing locally? We're seeing so many where houses are priced very high, they're coming down. So if you have some flexibility in your needs and wants, you can get a great deal. You could get or at least feel like you're getting a deal. I don't know if anything's a great deal right now, but you could feel like, okay, it's nice to be able to say like, hey, you know what? This home was listed at 800,000. I got it for 770. Like, that's a good feeling, and I know for sellers, that's not what they want, but it's all about pricing the home correctly to begin with. So for buyers, having some flexibility in what you're looking for can make a huge difference in getting into a home right now. I'm fortunate where a lot of the buyers I'm working with do have that flexibility, and they're willing to look at stuff and say like, okay, can we make this work? It's like, yeah, if you can have that vision to say like, all right, this may not work on day one, but this is going to work on day 900. That's
Grow
what
into it.
that's exactly, that's the mentality. If you have that right now, you could really, really win in this market. And then if rates do come down, hopefully, knock on, I don't have any wood here, drywall, here's wood. Like, if rates do come down at some point, then it's an even better investment. But once you get in and you get started, it gets easier. That's the biggest
Yes.
thing. It's getting in, it's buying the home, and then it just gets easier after that. You're gonna have to do projects and all that stuff, but get in, make something work, and make it work years down the line, because we've had this conversation too. It doesn't need to be perfect, because if most first time home buyers are young, they're gonna have a family, whatever. You're gonna have kids, and they're gonna ruin it. We've talked about that before.
It's
Destroy
very true.
everything.
Very true.
So wait. So that's my take right now. If you're buying right now, be a little flexible. Look at houses that are just above your price range that have been sitting, and say, okay, can we get these down to where we want them to, and have some flexibility?
Yeah. Well, you mentioned the first time home buyers. I mean, one of the things, a government could do to help them is, maybe increase some of the loan limits, or not loan limits, the income requirements for these first time home buyer programs.
Mm-hmm.
It's the values are there. Those have been adjusted, but the income limits haven't really been adjusted enough, because there's a lot of that's available for first time home buyers. Outside of Sony Mae. I mean, Sony Mae is probably one of the best, loan programs out there for first-time home buyers. Um, they could use, I think they could qualify up to $230,000 in household income, which is a decent income for, two people starting out, or a single
Mm-hmm.
person starting out. So,
Yeah.
and there's advantages there with down payment assistance, more favorable rates. But if we could even tweak those income limits a little bit, that could help a lot of people on the first time home buyer side, get in and get a leg up. What we've been working on a lot with first time home buyers is using multiple grants. We call it layering. So we use Sony Mae as like the foundation of the financing, and then take advantage of whatever offerings that they have, and then piggyback that with a local organization, maybe like CHI or Long Island Housing Partnership, CDCLI. There's a bunch of them, and sometimes you can get them to fit into that box. And if they can fit into that box, great, because you're going to be able to get grants from two different institutions, and make your home, much more affordable than you would have outside of that. So, those are great options for people. For minorities, I don't know if you're familiar with this one, but Sony Mae has a credit is due program, and that is offering a 1.5% rate reduction from whatever their prevailing rates are. So
Wow.
right now their rates range from 5.6 to 6.3%. So you take 1.5 off of that, you're looking at some rates in the fours. So I mean, it can't get any more affordable than that, right? So there's a huge advantage. We're only one of 7 lenders in the entire state of New York offering that. So definitely pass that along. And the last thing I'll say about Sony Mae, they made another change. They implemented something called RSL, which is a recoverable second lien. So normally under Sony Mae, they offered a forgivable 3% grant up to 15,000, which over a 10-year period, it's completely forgiven. Whereas this one is not forgiven, it's repayable at the time of a refinance or a sale. So there's no interest that's accruing, there's no payments being made. It's just a 5% no cap. You buy a $700,000 house, the state will give you $35,000 as a down payment. You do not make any payments until you sell or refinance. So at least there's some options out there for folks. And again, with the $230,000 income limit, that does open the door for some, some good, I believe some, decent amount of potential home buyers to secure,
Mhm.
some of these grants. So I encourage you to inquire.
Yeah, I mean that's like, that sounds like a lot of people, like public service people, that are in state jobs, like a lot of, I'm sure, union jobs too, cops,
Law
firemen,
enforcement, yeah. MTA,
teachers.
yeah, all of it.
Right. Like this is, we know those salaries don't start out super high. So this is, like you said, a door that works. I mean, and especially young people getting together and whatever, getting married, like that's a huge opportunity. Um, I think you have to leverage every opportunity that is brought to you, in order to buy right now. Like you have to try and take advantage of all these things. But like you said, there's only so many banks that offer these types of things. So it's really important to do your homework
Right.
and find out what's out there because, one of the things that I'm sure people see is if your bank doesn't offer this, or, if you know someone that's an LO and their company doesn't offer this, they're probably not going to talk to you about it because it's not a program that they could give you. And it's not that they don't want to give it to you. It's just like you're at the mercy of what banks could do. The thing about agents is like you could go to any agent. It's all about what the agent knows, right? It's all about the experience you get with them. And it doesn't really have too much to do with the brokerage except for the tools that they give you. Whereas like when you're getting a loan, there are a lot of like every time I talk to you, I feel like I learn a new thing, like something new. There's a new program, there's new this, but that's also, again, you're super knowledgeable and I feel like you would know this stuff anyway, but like you're working at a place that they provide these opportunities to these buyers. And that is like so key. You can't leave any stone unturned.
No, you can't. I mean, I'm fortunate that I've been originating for over 20 plus years. I've worked for retail giants like Wells Fargo and Citibank. I've been a mortgage broker. For the last 10 years, I've been an independent mortgage banker. I chose this platform to lend simply because they offer so many different things and they really do put the consumer first. So for me, it was a very easy decision to make to align myself with a company like this. Yeah, I mean, listen, man, I can go anywhere. But I choose here because it gives me the most opportunity to help people. At the end of the day, we're in a service business. We're here to serve the community. How do you serve the community if you don't have the tools? Right? I just don't understand it. So,
Mm-hmm.
and I appreciate, obviously you being a part of the Nest Egg team and providing these services to your clients. But, it's a head scratcher to me when, I see other people not doing that. It's not that they don't know, it's what they're comfortable with a lot of times, right? So,
Mm-hmm.
and there's definitely a negative mystique out there about some of these programs. Yeah, it may take a little bit longer, maybe an extra week or two. It's not a reason enough to not help somebody and give them the opportunity to succeed, right? I mean, that's the reality of it. So, hopefully things like this help and people can, get a little bit of an understanding for what's out there and know that, these things are great. They're just great opportunities and like you and me, and that's why we work well together because we care about what we do and we want to make a difference.
Yeah. Well, and you were saying it the from the listing agent side, like you're saying, like, yeah, these things might take an extra week or whatever. Like I always tell my sellers, like what we want to see in offers, is I want to see security to close. Like that's what then, you could, me personally, I would leave 10, 15, 20 grand on the table as a seller to make sure that I have a buyer that is well qualified, that their LO knows what they're doing. Like all those things are so important to me. Like to me as a listing agent, want to like I don't care what the program looks like. I don't like if I call to check up on that pre-approval and I don't get an answer or I don't get a response back really quick. I know some people you can't answer the phone all the time. I'm one of those people. But like if I don't get a call back explaining to me the underwriting that you did, how secure they are. Like, can they go, like, if rates shoot up, can they, like, if I'm not getting that from you, I don't feel secure as a listing agent. And I'm not going to sway a seller. I'm not going to say, hey, like, we can't go with this person because of the yellow. No, not at all. But when I do present that offer, I'm going to say, we checked with this loan officer, haven't heard back from them, not sure what kind of underwriting they did, not, don't know if they just like took the buyer's word for it, whatever. Like, we don't know because we don't have the information. And that could make a huge difference. Because again, nobody wants to get into a deal and have it fall apart. So to me, it's just like, can you show me and prove to me that this buyer is fully vetted, that they are a lock to close? As long, obviously someone could go and, buy a Ferrari, and that's a whole different story. But
Oh, yeah.
if everything stays the same, or how much of a lock are they to close? Like how much wiggle room do they have if things went haywire and interest rate shot up 2%? That's what I look for as a listing agent, and I want to be sure of. So having, again, someone like you who, like, I don't think I've ever had a buyer, like, we've never had a buyer that was on our listing, right? Like that a buyer was using
Oh,
you that
using
came.
me to buy you one of yours? No,
Yeah.
I don't think so. Not the other
But
way.
like, but if it happened, just know, and knowing, like, where I could talk to you and be like, how are we secure? Like, and I know what you do for underwriting because I've had so many buyers that use you. So like, there's a level of comfortability there for listing agents knowing that the deal is going to be secure. That's so much more important at times than money, because again, like, if someone's doing, I don't know, whatever, I'm not going to get into it, but yeah, my point is made. Security is great. We want
Yeah,
security.
so I mean, and that's why we go ahead and we encourage our clients to get pre-commitments so that, it's not just pre-approvals from a loan officer. They're actually fully underwritten and vetted, approvals. So that goes a long way in giving you that security that you're looking for.
Mm-hmm.
And a lot of times too, when we're starting to go through these grant opportunities, we're encouraging people to start that process, prior to, as before they're out there, hitting the pavement. Make sure that your ducks are aligned and your I's are dotted and your T's are crossed, right? I mean, it's all about preparation. The more prepared you are up front, the better experience you're going to have, and ultimately, that's going to hopefully get your offer accepted over somebody else's because you've done your due diligence. If you're coming into to a situation where you're not prepared, they're going to go somewhere else. So you speak the truth. That's just the reality of it.
Yeah. Well, and we got two offers accepted this past summer. And one of the biggest reasons was hearing from the listing agent was the fact that those buyers were pre-committed,
Yeah.
as opposed to pre-approved. And they weren't the highest offer in both scenarios, I don't think, and it wasn't about money, but having that pre-commitment and
Mhm.
being able to say, like, look, they've already been guaranteed this money.
Right.
Money's not an issue. House has to appraise still, whatever, but having that guarantee that the money's coming from the bank, like, yeah, we like the buyer so much, they're so financially secure that we can give them this money, made the difference in two deals in the height of the market, super competitive houses, multiple offers, like at least like probably double digit offers on both of them. And that pre-commitment was the step that put it over the edge, even compared to cash offers. So it's a huge plus. I'll ask you one last question about it, because I was thinking, I'm surprised this didn't come up right away, because I was thinking that this is also a solution. But if you want, do you want to tell us just also about the all-in-one, and how that is a viable option compared to the 50-year also? Because like we've talked about it before, but I think that's a true out of the rat race hamster wheel loan that could be done.
Right. Well, it's not really necessarily geared for first-time home buyers. It's really more geared for somebody who's a little bit more financially, set or established in their careers. They're cash flow positive. But it's essentially a first lien HELOC that's tied to a checking account, and it focuses on principal paid first rather than interest paid first, like we were talking about before. Traditional mortgages, your interest is predetermined over a 30-year period. Here in this format, when you go into a first lien HELOC position, it's simple interest, and you're paying interest on a daily basis based on a moving balance. So depending on how your cash flow is operating, that can be hugely advantageous because you'll be able to attack your principal in a way that traditional mortgages don't allow you to do. So essentially, you're creating your own banking ecosystem using the equity in your home. So you become the bank. You exclude the bank. So like I do all my banking through the equity of my home. It's quite liberating and it's quite awesome to see your balance start, dwindling down because you're not tied to, this amortization schedule. And when you consolidate everything and you allow your money to work for you in a way that it's not currently doing now, you start to see the real benefits of it. I mean, look, at the end of the day, your money sits in a checking account and it doesn't do anything for you other than just sitting there waiting for it to be used for bills, right? So if you can maybe change the way you approach your everyday finances, where for me, like I charge everything. I don't use my debit card like I used to. And then so essentially every dollar I make, there's a sweeping technology that gets that money and applied towards my principal, so my principal drops. And then because my interest is being calculated on a daily basis, subsequently I'm going to be paying less interest because I owe less. And I use my credit card for all my expenses. And at the end of the month, I reconcile. I use my mortgage to pay off my credit card, and I rinse and repeat. But as long as my income is outweighing what I'm spending on a monthly basis, that additional money is what's working to my advantage and attacking my principal. It's the same thing with like your escrow, your money that's sitting in an escrow account waiting for your taxes to be paid. How is that serving you? How many people out there are having low interest savings accounts? Meanwhile, they're paying 6, 7% on a mortgage. Like,
Hmm.
so this model gives you that security. So you don't need to have that low interest bearing savings account. So it's a completely different way of just managing your finances and a different mortgage approach. So again, not for everybody, but for somebody who's looking for more functionality out of their house or their mortgage, they want to use it for investment purposes. This really could be a great way to hammer down your debt. They say that historically speaking, in this program that's been in place for over 20 plus years, the average person to pay off their mortgage is between 5 and 7 years. Can you imagine that? I mean, you can pay off three different properties in the same time that it would have taken you through, a conventional mortgage would. So, for anybody out there that's making good money that has a mortgage that would like a better strategy to getting through your debt, definitely give me a holler because this is something that I'm utilizing myself and I'm seeing some tremendous success in it. My first year of doing it, and again, this is going to be different for everybody because your expenses are different, your income is going to be different. But for me to have paid off $70,000 in my first year of having this loan just goes to show me that it was just really mismanagement of my finances, and being able to now consolidate everything and to have everything under one loan and to have this ability to pay principal first. And again, in an environment where I'm commission based, so somebody like you, and again, who's in commission, somebody who's bonus based, that makes some large chunks of change, or has rental properties, any type of streams of income that you have coming in, all promote principal reduction and getting through your mortgage in a way that traditional mortgages aren't designed to do.
So you just made me
It's a
have
mouthful, I know, it's a lot.
no, but you just maybe have like an idea. I know you're saying this is not for her first time home buyers, but I have to ask, is this available for like a condo or a co-op?
Yep, condos, yeah, condos,
Okay.
co-ops, it's all the same.
So now you see where I'm going because if I am so I my biggest regret is not buying something when I was younger, like which I wish I did. I wish I bought a house and house hacked it, whatever. Which is again a possibility for this. Um, you would just have to have legal rent, whatever. Let's say you're gonna buy a co-op, right? You could get a very affordable co-op, right? You can get a co-op still for some of them like around $300,000, maybe even lower, depending on
Sure.
where, right?
Yep.
So now, if you are dual income, if you're two people who can buy a $250,000, $300,000 co-op with this loan, and you could pay off this entire co-op in 5 to 7 years and then set yourself up for your next purchase of a house, you're going to have 100% equity. You're going to have that fully paid off. Whereas if you went with a traditional 30 year, you're going to be in these same numbers that we saw, where you're going to walk away with a down payment. You're going to walk away with 150K. Great.
Right.
That's awesome.
Right.
But imagine you could just walk away with everything and you're paying so much less interest over time. So, whatever the interest payment that pays out after that, you're actually paying X for the place. It sounds to me like that's a complete win if you were to do that. So you use the all-in-one loan to buy a co-op or a condo and you pay that off and buy it young, buy it when you can. If you start working at 25 instead of, like you said, throwing money into a savings account and saving up and building up that down payment, if you could put that into a property and now you're paying off that loan with the all-in-one, by the time you're 32 and then you decide to start your life, start a family, whatever, like you're going to have all the equity and the appreciation from the condo or co-op that you bought. As long as market conditions stay the same, you're going to be in a much better financial position to use that. To me, it's like,
It's a no, and it really is. And when it sounds interesting in theory, and a lot of people, I guess in the marketplace, it's called velocity banking. So like if you're looking for more information on the all-in-one, velocity banking is kind of something similar to it. The concept is the same. But yeah, it has a significant impact on how you can pay down your mortgage. And it really is a wonderful thing. It was originated out, I guess, in Australia about 30 years ago. It was brought to the States about 20 years ago. It's just starting to really take shape, and a lot of folks are jumping on board. And once you start to see the math behind it, and you can see what it would look like for you, that's where it makes all the difference in the world is seeing what this could look like for you. I mean, I could have continued on my way and still had a mortgage for the next 13, 14 years. I'm on pace to paying off almost $500,000 in about 5 years. That's pretty damn good.
Yeah. Pretty damn good.
Yeah. So anyway, but Johnny, it was great. It was great catching up with you as always. I hope the 50-year mortgage insight there helps out everybody.
I think it will.
Yeah. Hopefully they make some it can't just be the 50-year. Like there's got to be some other benefit there for our consumers to make sense. So
Yep.
we'll see how things kind of play out, and then we could always circle back with each other, when that comes to fruition.
Yep. All right. Well, John, thank you again. Your knowledge and insights are much appreciated.
Anytime, brother.
And yeah, if anybody has any questions, you know where to find us. We're pretty easy.